the changes of the exchange rate 1 year ago, about 2%. What do you make of it now?
Well, I think it's a very important step forward. I think there's a great deal of progress has been made over the last year. China now has a more flexible exchange rate, and they've announced new policies for determining that exchange rate that take it away from being tied so closely to the dollar, which was a big disadvantage for China, and move to manage it primarily with reference to a basket of currencies. So I think we have more flexibility, more market influence, and more transparency. So I think on all three criteria, this reform has been a big success.
Of course, that was 1 year ago. It was being termed by some as exchange rate reform, by others as devaluation of the RMB. What do you make of it, Mr. Xu, now 1 year later at that moment?
A year ago, I think China did the right thing. Now, in hindsight, it should have been done earlier, and the magnitude should have been greater. But having said that, I fully agree with Professor Lardy. I think we have seen a lot more transparency. We have seen a lot more fluctuation, and firms and individuals actually are becoming a lot more relaxed about the exchange rate fluctuation. This is exactly the aim of the reform.
But remember that, I mean, 1 year ago, there was quite a stir in the market.
Right.
In fact, the people reacted to it anxiously. Exactly. Remember, they were talking about, as a result of this devaluation, maybe there would be a problem with geopolitics in the region. And they're also talking about, you're going to have dominating cheaper Chinese exports to the rest of the world. What are you going to do with this? So now, 1 year later, have any of these two become real concerns?
Well, first of all, when people say devaluation, we talk about 1.8% decline against US dollar. For most major currencies, this is less than the daily trading range. Secondly, let's look at the fact. In past 1 year, many emerging market currencies, Asian currencies, they have remained quite stable. So actually the market is a lot more prepared than what consensus had dictated. I think people expect this. This is okay.
All right, let's take a look at some of the numbers. Probably it could help us to understand more because we're really talking about real economists here. Statistic has been showing that Chinese exports still falling since that, well, about 2% exchange rate change. China's total exports by value fell by 6.25% to more than 180 billion US dollars in June, down from over 192 billion US dollars in the same month last year. So that's a comparison between this year and last year. Exports in the first 6 months are also down 2.1% year on year. This raises the question, of course, whether the devaluation a year earlier necessarily led to more Chinese exports all over the world, or rather the exports are being dominated by other factors. Mr. Lardy.
Well, I think when you analyze what's been happening on the trade front, you have to take into account changes in prices. And we've been in a deflationary period, particularly for major commodities. And so when you look at the growth of China's trade in real terms, as opposed to measuring it in dollars, it has been quite successful. China's share of global trade is still going up fairly strongly. If you measure things in nominal terms, China's trade declined last year, but global trade declined much more. And when you put it in real terms, China's trade is growing several times faster than global trade. So I don't think this move on the currency was in any way motivated by what's happening on the export side. China's share of global trade's been going up ever since 2001, and I think that continues now. China also has a still significant trade surplus. So I don't think the currency move last August was in any way motivated by what was happening in the external sector. I think it was motivated by some of the factors we talked about earlier.
Right.
And particularly the IMF's suggestion that the exchange rate should be more market determined. Remember, the IMF had laid that out as one of the criteria that they would use when they decided whether or not to include the RMB in the SDR basket.
Right.
So China made the move in August, and that was one of the factors that pushed the executive board to include the RMB in the SDR basket when they finally voted in November of 2015.
Yes, indeed. I think there are two issues here, Mr. Xu. One is whether the earlier suspicion that China was using the exchange rate change to boost its export is really true or not, as Mr. Lardy already argued. The other thing is there has been a global slowing down of trade anyway, and China's proportion in this global trade, what has been the current status, does that have anything to do with the RMB exchange rate change? Of course, Mr. Lardy already put out his opinions. What about yours?
Well, my opinion is, first of all, if we look at trade surplus, I think that's correct. We look at that. Roughly each month, we have about 40 to 50 billion US dollars trade surplus. So that's actually suggesting RMB was not overvalued to begin with. But on the other hand, if we look at, just real estate, stock market, RMB denominated assets, clearly there's a strong need for Chinese companies and for Chinese individuals to diversify their investment. That's going to drive the exchange rate lower. In fact, imagine if China adjusts the exchange rate in 2008, 2009, not doing this 4 trillion RMB stimulus package, today we'll be in a much, much better situation.
Having said that, though, what do you make of the next step? Because we are already approaching October the 1st, which is the day when the RMB being included in the special drawing rights basket. So what would that mean in terms of China's preparedness from now until then, Mr. Xu?
I think there are a few ways to look at that. First of all, once RMB officially being included in the basket from October 1st, China would be subject to fewer constraints in determining exchange rate. So whether we want to adjust the exchange rate higher or lower, we can have more flexibility, that's for sure. Secondly, assuming China would continue to reform the mechanism, for example, allowing foreign investors to buy Chinese bond and to set interest rate more based on market forces, and that would internationalize RMB. So either way, I think the fluctuation will be greater than before October 1st.
All right. Mr. Lardy, your view?
Well, I think there's maybe some misperception of what will happen on the exact date that the RMB is included in the SDR. There are some central banks that will want to add RMB assets to their reserve holdings, but the number of countries that tie their reserve composition to the composition of the SDR is relatively small, and the Chinese RMB weight in the basket is not very large. So I don't think in the short run it's going to cause a big increase in the demand for RMB denominated assets. Over time, I think it could become an important force, but I think in the early days it'll be more moderate, more modest than some people are anticipating.
And as a result, Mr. Lardy, what would that mean for the pace of China's RMB exchange rate reform? As we all know, that is one of the most important barometers in determining whether China has been doing its financial reforms, which is very important task facing China right now. People are complaining about the speed, whether it's sufficient or not. What do you think? With that joining the SDR basket, will the reform be sped up? Will people have less concerns about so-called dangers?
Well, I don't think the inclusion of the RMB in the SDR basket is going to cause any big discontinuities in people's perceptions or in the markets. I think it will be a pretty seamless transition.
All right, and Mr. Xu?
I think your question is very good because we cannot look at exchange rate in isolation. If we allow greater fluctuation of exchange rate, that is good. At the same time, if we unveil genuine supply side reform, actually you could see capital inflow, which would put the exchange rate higher. Yeah.
So it's very interesting a situation. There are a lot of ifs. What if it happened, and therefore it leads to certain kinds of results. But having said that, let's ask you, both of you, an important question, which is about politics. We are seeing, of course, the G20 summit, which China considers as a big deal. And then there's going to be the US presidential election. And next year, there's going to be the 19th Party Congress in China. All of these events are extremely important for China-US politics. And we all know China and the US economies are becoming pillars of the world's economy, whether they necessarily admit it or not. But Mr. Xu, what would this mean for China's speed of reform of the RMB exchange rate, for the real RMB exchange rate going to be so-called according to the market fluctuation?
Again, there are many combinations and permutations. But from political calendar perspective, of course, with political calendar, there will be stronger emphasis on economic growth rate. Now, stronger emphasis
growth rate and also stability.
Yes. So stronger emphasis on economic growth rate probably would result in continued increase in terms of debt and leverage. So that would result in certain stress in financial system in the long run. So from exchange rate perspective, that would have downward pressure on the exchange rate in the short term.
Mr. Lardy, do you agree with that? Are those political events important?
Yeah, I think I do agree, and I would underline, I think we're entering a period of extreme uncertainty in terms of the overall economic relationship between China and the United States. There's a great deal of uncertainty about what will happen to U.S. trade policy, in particular, regulations on investment and other things that could change. And there's a chance for significant discontinuity on the U.S. side. Of course, I can't judge what the prospects for discontinuity on the Chinese side are. I would think they would be less. But as Mr. Xu said, a lot depends on the pace of reform in China. If the supply side forms move ahead, there could be significant additional inflows into China that would tend to cause the RMB to appreciate on a trade-weighted basis. On the other hand, if there's too much buildup of debt and a perception of increasing financial risks domestically, then there might be more pressure for capital outflows, which would tend to cause the RMB to depreciate. So I think it's very difficult to forecast what will happen to the exchange rate of the RMB going forward.
That's right. And the other thing, of course, is the capital flight. We've been talking about this for a long time, but this is such an important economic phenomenon these days for China. Of course, we've seen over the past few months, RMB exchange rate begins to appreciate a bit. And that would mean already less capital flight out of China, and yet people do not know the speed. So what would that mean from now to October if we are looking at the special drawing rights basket, and even further when we're looking at these political calendars, Mr. Xu?
I think capital flight is a too sensational notion. Right now, China has about 3.2 trillion US dollar foreign reserves. In 2005, China was very anxious to depack the RMB from the US dollar because the concern were we got too much foreign reserves, and too much then were about 700 billion US dollars, roughly 25% of today's level. So I think capital flight, this is too sensational. I don't think people are moving money out of China at any cost. I mean, that's not the case. I think this is just people are enlarging, reevaluating their investment universe, and firms are buying foreign assets. I don't think this is a capital flight.
All right, Mr. Lardy, is this a blind capital flight, or this is very calculated, good investment that we are talking about? The Chinese are making good of their wealth to invest overseas. What would happen with the RMB exchange rate reform, October the 1st, all the political calendars? Mr. Lardy.
Well, I agree. What we've seen over the last year, it should not really be characterized as capital flight. It's Chinese corporates paying down their foreign currency debt. Remember, when the RMB was steadily appreciating back in 12 and 13, and interest rates abroad were very low compared to China, a lot of Chinese corporates borrowed money in foreign currency. Indeed, foreign currency debt doubled. Then in the last year and a half, people's expectations changed. They thought, well, maybe the RMB isn't going to continue to appreciate indefinitely. Eventually, foreign interest rates will start to rise. So their expectations changed, so they began to pay down their foreign currency debt. They paid down the foreign currency debt that they held offshore, and they paid down their foreign currency debt that they had taken out from Chinese domestic banks. It was the same phenomena, but I don't think that's really characterized as capital flight, this kind of blind capital flight.
Right.
And I think it was a rational reaction to changed expectations.
I see. Before we go, we only got 10 seconds for each of you. What would you say, in one sentence or two, likely to be the prospect as we have witnessed already 1 year on with the reform of the RMB exchange rate regime? Mr. Xu.
I think people are becoming more relaxed.
Great. Mr. Lardy, are you as relaxed as Mr. Xu?
I think, yeah, I agree, and I think markets vastly overreacted a year ago. They become more rational. I think we're getting more comfortable with increased flexibility of the exchange rate, which is, I think, a welcome development.